Yeah, please allow me to share the our housekeeping rules here. Just give me 1 second here. All right, now remember to mute your mic when not presenting or actively engaged in ongoing discussions. Yeah, and please join the sessions using your agency code and name. That's very important, so that your agent is able to capture. So that your branch is able to capture your attendance correctly for this morning sessions. Only authorized corporate nominees are allowed to participate in the training, and be reminded not to share the training materials or any screenshots of this training on social media because compliance issue. And kindly stay till the end of the session to answer evaluations polling for your CB accordance here. There are only 9 questions in total. You can click 3 dotted buttons to resume the polling. In the event that if your line drop or whatsoever, yeah. And after you have submitted your polling, then what you need to do very simple. Just leave the meeting room and wait for a day. All right. Now, just for information that's very important, as a reminder again, yeah. On this reminder of market conduct essentials for intermediaries. All right. Now, as the intermediaries, right, please provide the product disclosure sheets, yeah, to your customer at the pre-contractual stage and at the time of renewal. That's very important. Now, for example, if you're selling Great Shield Home, our individual products, so ensure that you actually extend the product disclosure sheet to your customer, which actually spell out, all those plans available, those major exclusions and the benefits, yeah. At least for customers to have the minimum information to make an informed decision. That's very important as a reminder. Now, secondly, of course, to provide the suitable advice and recommendations to your customers based on their needs and objective. For example, let's go back to the same example, Great Shield Home product. Yeah, if a customer is actually expected to get the basic cover, because he's young, he doesn't need to have a very high sum insured, what do you call it, cover. Then perhaps plan one, the minimum is suitable for customers, and also also align with the financial commitment is able to pay for the year. All right. Now, the third one is very important. Please take note. Yeah, very very important. Please ensure that you actually complete all the mandatory courses and e-learning and meet your CBD hours to maintain your competency to fulfill the role and responsibilities of an agent. Yeah. Now, we have 6 mandatory e-learning for this year. Very important, yeah. You all need to complete it by 31st December 2024. If you're unable to complete, then your front-end system will be blocked to issue new cases. All right, I repeat, you must complete it by this year end. Otherwise, your front-end system will be blocked to issue new cases. Now, do it earlier, do it now, yeah, because there are only 6 topics. If you do it like 2 e-learning a month, so by 3 months, you should be able to complete 6 e-learning. Don't wait until last minute because you could have technical issue that you're unable to go in, to GG-Link, or what happened to, your idea or whatsoever, yeah, so that actually do not allow you to complete, then, your front will be blocked for the, for those, what do you call it, the, existing agents. Now, for new agents, please take note if there's anybody happen to join as a new agent, you need to complete this 6 mandatory e-learning by half a year from your appointment date. For example, if you join in February, make sure that you complete your e-learning by this July here. If you don't complete your e-learning, 6 e-learning by July, yeah. So again, this front-end system will be blocked to issue new cases. All right. Now, the third one here will be actually on the do not use customer data without getting the customer's consent. Let's go back to the examples I mentioned, like Great Shield Home. This customer already bought the Great Shield Home from an agent. Yeah, congratulations, good enough. Yeah. Now, and of course, obviously, before the application is being processed, yeah, so the customer will release the personal information to be filled in the application form for a Great Shield Home. Now, done deal already. 6 months down the road, if customer want to buy, let's say, our medical product, let's say, EasyMac Major, all right. Now, you have to get another consent from customers for him or her to release the personal data to you. Yeah, so you cannot actually cut and paste the earlier one includes you home into this, the application of the medical products. No answer is because each consent is only for one purpose only. It cannot be used for any other purposes, right? Now, do not induce customers to purchase or renew insurance products by misrepresentation or use any sales brochure illustration not authorized by GGM. There's no. Induce in a way that, because some agents may want to get a higher commission, so he actually, you know, recommended a higher plan. So answer is no lah, huh? So we can't do this because we're gonna induce customers to purchase insurance because of our own advantages. All right. Now, do not exert undue influence or threat customers to purchase insurance products or demanding insurance premium. There's also no. I mean, sometimes, once a while, a casual chat with customer over the phone, yeah, is good enough, yeah. I mean, or even, come to see him when the policy is due for renewal. It's good, yeah. Of course, it's also an opportunity for the agent to create more sales, yeah. But we cannot be actually, calling customer there at night just because we want a sales. So that's quite an unethical practice, all right. We're talking about unethical practice here. As under the Financial Services Act 2013, we must treat customers fairly, all right. Now, another thing I want to let you all know is actually that, as you all know, now the WebEx has updated its version, yeah. The polling is actually resided in the Slido, SLIDO Slido polling, yeah. Now, if you're using a handphone, no worries. If let's say your line drop, yeah, you need to just click the three dotted buttons, which I pointed out here. All right, then you actually go into advanced icon and you click, you able to see Slido, just click Slido, then you're able to launch do your polling, right? Now, for those that using the laptop, they're very simple, very similar layout here, yeah, at the bottom of the screen, right? On the right hand side, see the the three dotted button here. Click it, and then you're able to see Slido, then click the Slido, then you're able to do your polling, right? Now, so without further ado, so let me pass the host to Mr. Yap. Yeah, Mr. Yap, over to you. Yeah.
Yep. Thank you, Alex. Can you all see the slides?
Mr. Yap, I hijacked your screen already. I should need to reshare your slides.
I'll reshare my
Yeah.
slide again. Okay.
Yeah.
Can see the slides now?
Yes, can see the slides. Yeah.
Okay. Good morning to all fellow agents. Today we are going to go through business interruption. I think Alex mentioned that last year I also did the same topic, and hopefully this year we are almost covering everything is similar. Just that maybe some of you may not be very clear exactly how it works, or you need more clarification. I need a refresher. This will be the session that you can make some clarification lah, or refresh yourself how actually it works, for better understanding lah. For new agents, welcome. This is a business interruption session, which is more or less what you call you should sell this together with the fire material damage, which we have done a session last month. Yeah. What we're going to do today is a few areas. The first thing that we're going to talk about is why do we need business interruption insurance? And second thing we're going to do is to explain to you what does business interruption cover. The next session we talk about how loss profit is determined, because your business interruption actually covers loss as gross profit. So we're going to go through how we determine this loss profit. And if we look at extensions, like any other policies, there will also be extensions. There will also be clauses applicable to the policy. And we look at how rating is being computed for con loss policy. And lastly, we do some case studies just to refresh ourselves what we have done during the whole morning. Yeah. By the way, business interruption is also known as consequential loss policy. if some of you are more familiar with the word fire consequential loss policy, it's actually the same. Business interruption is the same thing, just that the name is different. That's it. Yeah. So usually, I presume when you go out to the market, most people will talk about fire consequential loss rather than we call it business interruption. Yeah. So it's the same. Actually, it's the same. Now, okay, we move into the first area where we talk about why do we need business interruption insurance. I would I would relate this to a chain reaction. When there's loss, there's a fire damage. What is the consequence after the loss, as far as the insured is concerned? Yeah, as far as the financial, the operation of the insured is concerned. The first thing that we look at is staff. After the loss, what will happen to the staff? Staff may look elsewhere for another job during the recovery stage. Yeah, so some of them needs to continue to earn living. They are not be very comfortable whether they will continue to get salary, and they also not sure whether the insured may may slow down their production after even recovery and so forth. So they may look for elsewhere for another job. Yeah, of course, when you do that, once the business is recovered, the insured may have manpower shortage. When you have manpower shortage, some skilled workers may have left and joined other companies. Therefore, the insurers will be not be able to produce, so there will be a reduction in productivity, and also the quality may be compromised because skilled workers may have left. On the other side, there's a financial impact. The insurer will also face financial challenges. They may lose a lot of existing customers because existing customers, once you cannot produce, may look elsewhere for other suppliers, may be limited or no new customers. New customers, when they see you cannot supply enough, they may also be looking elsewhere from other competitors. Yeah, your production obviously will be temporarily suspended, or if the factory is not fully burnt, you may still be producing, but it will be in a reduced capacity manner. Yeah. Of course, it will lead to production loss, unable to meet customers' orders, and eventually unsustainable profit. Unsustainable profit. So the insured cannot continue to produce the profit as they used to be lah, yeah, before the loss. That will lead to lack of funds for the insured. There is no profit, cash flow is impacted, then results in cost to rebuild the business is impacted. To pay for additional costs involved in minimizing maintain current production also will be impacted, because when the factory is not fully in operation, there will be additional costs involved to restart the business. Yeah, we will talk about this additional cost later on because it's one of the covers that is under the con loss or the business interruption policy. We call it actually increase in cost of working. We'll be using this term quite often, quite regularly in the session. So it actually means additional cost to reduce or maintain current production. Yeah, we will look at that in more detail later on. Then they will meet challenges to maintain operating costs. Yeah, even when the business is not operating, the insured may still continue to have to pay salary because you want to maintain some of the staff. You have to continue to pay salary. You also need certain staff to actually restart the business. So salary must still be paid. Bank charges must still be paid. Rental must still be paid, and etc. This we call operating costs. Will still have to continue. Yeah. Now, why do we need business interruption insurance? What does business interruption insurance assist the insured to manage this chain reaction? Yeah, we go through it, and in the overall picture, how business interruption will help the insured. When you look at the first item, talk about staff moving elsewhere to another job. The policy actually covers business cost of business and also salary apart from profit. So in other words, insured is not too concerned about not able to pay salary because this is part of the cover in the business interruption policy. And of course, that will lead to higher staff retention. Your productivity may still remain stable. Quality may not be compromised because you are able to maintain most of the staff. Yeah. What about financial challenges? How does this business interruption insurance helps the insured? It actually covers the gross profit, which includes the fixed cost. Yeah, fixed cost is what we talked about just now, the operating cost. Yeah, you also cover the operating cost. You also cover your your gross profit that was lost. Yeah, because the insured didn't produce sufficient. Yeah. So what happens with that? If the business interruption policy pays for this, then your current recovery time is reduced because you have now some funds to set up your recovery to pay for all your recovery costs. Your production loss is now minimized. Your profit can be sustained because the insurance policy actually pays for the loss in gross profit. Funds available to rebuild. The policy pays for it. Therefore, you have funds now to rebuild the building or rebuild your business. Then the second part, the policy covers is also increase in cost of working. Uh, Remember, we talked about increase in cost of working here, the additional cost to minimize or maintain the current production. We call it increase in cost of working. The business interruption policy also covers this element. Therefore, you are able to pay the additional cost involved to minimize, maintain current production. So in this slide, you can see that the business interruption actually has helped the insured to seek recovery or to minimize recovery expenses that they may incur. So business interruption is actually an important policy for all the business people who conduct their business, in particularly those factories. Yeah, factories will be even much more required to purchase this particular policy. Then if you look at, say, any insurance portfolio, you always find there are more higher policies than the business interruption policy. Yeah, that means some insured may just buy fire policy without buying a business interruption policy. Why is that so? Why is that so? Yeah, by right, if I mention this now, you buy a fire policy, you should have a business interruption, but this is not the case. Why is it? What I can understand is, or in my opinion, this could be some of the reasons that we find some insured do not buy a business interruption insurance. Number one, they are not sure how to compute the gross profit because in the later slide you will see why I mean they don't know how to compute gross profit because it's not the same as accounting gross profit. Yeah. So they don't know how to compute. So it doesn't matter lah. Even I lose, I won't lose a lot lah. Basically, that will be the the thinking. Yeah. Understanding the cover is also unclear. How does this business interruption policy actually works? I also not very sure when there's a claim, how do we pay out and so forth. So I'm not so sure. If I'm not so sure, what am I buying actually? So that's why they say, hey, since I'm not so sure, what for I buy this insurance? You know. And there's always a challenge to explain to the insured how claim is assessed because claim assessment is a little bit different from the normal policies that you buy, the property policies that you buy. The property policy is basically looking at what is damaged. We pay for whatever is damaged. But in business interruption, we are looking at loss of gross profit, which is the future profit. So you need to do a little bit of prediction or assumption of what the gross profit is supposed to be, in the future, in the near future. Yeah. So, however, what we're going to do this session is we're going to explain to you how claims is actually assessed during this session. Yeah. So that you everybody will understand, but a bit more of how gross profit is computed, how claims is actually assessed. Yeah. under this policy. To help insured or agents understand, we need to have more education to understand business interruption insurance. That's the reason why this session is going to help you to understand better. Yeah. The next thing, the insured may be thinking is not necessary to purchase as that is actually minimum disruption. Some business may be able to continue, yeah, even though there's a loss, continue in the sense that they may be able to operate in another premise. You may have situation where there are subsidiaries or there may be other factories. A factory could be in Klang or even Penang, and they set up another factory could be in maybe uh, in say in Seremban, Seremban area, one in Penang and so forth. So when there's a damage in Penang, then obviously they say they can actually increase their production in the other factory. So there will be a minimum disruption in that sense. Yeah. Then they may be under perception that when there's a fire loss, they may not lead to a loss in gross profit. As I said, they may have another factory somewhere else. They may also have excess stock available in certain warehouse, that they can use quickly. Therefore, it will reduce the impact of any loss in profit. While they are recovering, they have the excess stock to actually still continue supplying to their customers. So they may thinking, not necessary to buy business interruption then. Yeah. So however, there may be very little disruption to the production or sales or no loss of gross profit, but don't forget, insured will still incur additional expenses, which is covered under increase in cost of working. Remember, I said you will still have to continue paying the operating costs, bank charges, and things like that. And also, you also have to incur additional costs to do a little bit more work in another place. Yeah, I can give you an example in the sense that, let's say you are now able to produce in another factory, but then again, to produce in another factory, that factory may have to work additional hours, yeah, to to cover up the losses of production in the factory that was burned. So the additional hours that they have to produce is considered as increase in cost of working that is payable under the policy. You may also incur costs to pay what you call overtime pay, overtime wages, overtime pay to your staff who have to work extra hours in the other factory. So this is considered as increase in cost of working. Everything has been everything that the other factory is doing, you may have to incur additional cost. Power, we need more power, more cost. Maybe the delivery cost will be increased because the factory that is in Seremban, in another area, they need to send their supply back to Penang for the customers in Penang. There will be additional cost of delivery. These are all additional costs that is covered under additional cost of working in this business interruption. Hence, if the insured has this particular perception, no need, don't forget, this particular cost increase in working can be covered under business interruption insurance. So in that sense, it is also important that even though the customer thinks there is little disruption, but you can still recover additional cost in working in this policy. Yeah. So it's important to also purchase business interruption. Yeah. Okay. So basically, in these few slides, I just introduce to you the concept of business interruption, why you need it, uh, what are the minimum cover that you will find in the policy. Yeah, but we will go through it one by one and hope you can understand better a clearer picture what is business interruption all about. Yeah, so far okay. Okay, if everybody is very clear of the concept. Now we go into the details of business interruption. What does this business interruption cover? The slide that you're looking at is actually the first part of your policy wording, your business interruption policy. The first part, the first section, we call it preamble of the policy, says this particular, what you see in this particular slide. A bit of wordy, but basically I can summarize with what it's trying to say in this particular session in the next slide. Okay, it summarize. We summarize it as follows. Number one, it says that the property that you are insuring must be destroyed or damaged. There must be a damage or destroyed or partially destroyed on the property that you are insuring. Yeah, it could be the building that's on fire, the stock has been damaged, your plant equipment has been damaged because there is a fire loss. Yeah, and of course, they must be insured under a fire material damage policy. They must have a fire material damage policy before this business interruption comes into play. Then the claim under the fire material damage policy must be paid or payable, or a liability must be admitted. That means the fire policy, the fire material policy pays for the loss of the property. Yeah. Then only it will lead to a situation where the business is now interrupted or interfere with. That means the insured cannot continue producing or cannot continue the business, or partially damaged or partially cannot produce the same amount that they used to be. Yeah. Then after this, there must be a sum insured. The sum insured and the liability of the insurer shall not exceed this sum insured. Basically, this is in all what is inside here. I can summarize in this manner. Property insured, destroyed or damaged, they must be covered under the fire material damage policy. The fire material damage policy must be payable, and there must be a liability admitted. That means the policy, the fire policy, there is actually claimable. Yeah, that means insurance company is agreed to pay for the loss. Then leading to this, there must be a interruption or interference to the business, or the factory has not able to produce what they used to be. Then of course you must look at the sum insured, must not exceed the sum insured. Yeah. So basically, it can be summarized in this manner. The first part of your policy wording. Yeah. What do we cover? What can be insured under a fire con loss policy or business interruption policy? Number one, you can insure the gross profit. This is where most policies you will see them insuring gross profit. Basically, because those people who buy business interruption policy usually are manufacturing based. Manufacturing things is very important that they must have a gross profit because they cannot produce. Therefore, most policy you will see is on gross profit, which is meant for manufacturing industrial, ensuring net profit and fixed cost. We'll explain that later, what is net profit and fixed cost. Yeah. Then what else can you insure? You can insure a gross revenue. This gross revenue is actually meant for business where it's fee-based industry. Yeah. Fee-based industry is like hotel. Your hotel is not producing anything, it's providing a service. So they are collecting fees. Fees is your what you call cost of renting the hotel rooms. Basically, it's fees. Then the professional services, like your accountants, your architects, these are services that they collect fees. Their income is fees, not a production. Likewise, universities collect your tuition fees. Yeah, it's not a production. Yeah. So that's why you don't cover under gross profit. You actually call it gross revenue. Yeah. There's also element of gross rental. You may be a company where you are property management. You only manage the property and collect rental. So under such category, you only insure under gross rental, and it's not called gross profit. It's basically your income is actually rental. Yeah, so we cover under gross rental. Then another element you can insure is on increase in cost of living. I mentioned this now here, minimum loss, minimum destruction, therefore insured doesn't want to purchase. But you can actually buy a business interruption policy just to cover increase in cost of working. You also can do that. You don't think there will be any when it is disruption in gross profit, you cover increase in cost of working. Yeah. A really good example is ourselves, our insurance companies, right? Insurance companies usually will only buy increase in cost of working because very unlikely the gross profit will be impacted because all these service industries like banks, like insurance industry, will need a very comprehensive business continuation program. Yeah. What does it mean? It means to say if your head office or any particular premises is down, you cannot operate, then they must have a continuity plan where they can operate somewhere else. Yeah. Example, insurance companies, when the head office is not able to continue because of certain reasons, maybe it's a fire in the building and so forth, there will another site that the staff can go to and start their business, start working from the area. Some may work from home, some may go to that particular site to continue working because it's now technology is very advanced. You can connect to your system anywhere else, right? And all the hardware that is in the office is also there will be another site where also have all the data, even though the mainframe in the particular office is damaged, there will be another site who will store the same information. Yeah, so they can just continue in that misses, and and things will just continue as normal. So if that's the case, there will be any loss of gross profit, but there will be an increase in cost of working where you go to another site to work, you have to pay rental for that particular new premises. Yeah, people will charge you because you're going to occupy that place for a longer period. Your staff may need to go to there to work. You may give allowance to the staff to go to that new place. Yeah, you may have to rent certain new equipment, new computers, new laptops because some of the laptops may be damaged, and so forth. These are all only increase in cost of working. As I said, no profit is reduced. Profit still will continue because business is normal as usual. Only thing is there's an increase in cost of working expense that needs to be paid. So this is covered under the policy uh, if you just insure increase in cost of working. Yeah. That's why the reason is I put here is to say that it is mainly for business that can readily continue at any alternative premises. Yeah. Standing charges, you can also insure only standing charges. Standing charges is the same as the operating cost that I mentioned earlier. Here, you pay for challenging to manage the operating costs, your salary, your bank charges, things like that. This is actually standing charges, which you have to continue, which the insurer has to continue to pay even after the loss. So they may want to just buy on this area only on standing charges. This is basically recommended for only new business where there's no profit for the initial period, which means you are a start-off company. During the first year, you want to buy a business interruption. There's no profit yet. You don't expect to generate profit in the next maybe 2 years. It takes some years before you can build up the business. Therefore, as a start, you insure only these standing charges, which are still payable even there's a loss. You still have to continue to pay your bank charges and so forth. So this is element where you only insure your standing charges. Bill basis wages is recommended where The insured actually may think after the loss, I may want to not going to produce as much as before, even after the recovery. Therefore, I may need to lay off certain staff. So in this basis, you'll be laying off staff over time. Hence, your cover is based on new wages, where the payment of wages by under this policy is what you call lower as the months goes by. Perhaps the first month is 100%. The second month could be paying you 90% of the wages, total wages before, because you are laying off staff uh, over the next few months. So this is where new basic wages comes into play. Yeah. Okay. I also mentioned under gross profit, it covers increase in working, increased cost of working, and so forth, and standing charges. Hence, once you buy under the gross profit, the increase in cost of working, standing charges are already part of the gross profit, already part of gross rental, and also part of gross revenue. So these two elements here is actually already part of these three that you can cover. This is taken separately in case uh, the insured choose to only cover increase in cost of working or standing charges. Yeah, because of what I mentioned, where business is really available in another alternative premises, you only need to pay for your operating costs or your standing charges. Yeah. For this particular session, we are going to concentrate on gross profit. This is where most of the insured will purchase. As I said, most manufacturing risk will need a ground loss policy. Yeah. Uh, Even you have customers who are under professional services, accountant, you can still buy, but not to worry. The concept of how how gross revenue is derived or gross revenue is derived is the same. The way it is how it's being paid under gross revenue and gross rental, the concept will be the same. Yeah. So it's the same, just that we need to understand the concept first, then only we know exactly how to go about it. Yeah. Now we look at how loss or gross profit is determined. Yeah. So firstly, we mentioned just now, it's very difficult for the insured to understand how to compute the gross profit. Unsure how to compute the gross profit. Here, uh, in the following slides, we will now go through exactly how gross profit is determined. Yeah. In your policy, once you insure loss of gross profit, you will see this particular wording incorporated into your policy. We call it specification. It spells out how it works, how gross profit is being assessed, what do you term by loss in gross profit, how do you work out gross profit, and so forth. Yeah, it's a very lengthy wording. Is appearing in your policy once you select this. However, I can summarize it again in this particular slide. The first part of the specification actually tells you what is payable under gross profit. Yeah, it is limited to the loss of gross profit due to reduction in your turnover, increase in cost of working. That means to say, uh, when you when there's a turnover, you derive a profit out of your turnover, right? So when there's a damage to the property, what will be the reduction in your turnover? That means by right you're supposed to produce X amount, but because of the interruption, I can only now produce X minus Y, X minus whatever. So we got to know what is actually your reduction in your turnover. We will go through it, not to worry, we'll go through it afterwards. Just that I need you to understand that concept first, that your gross profit, your loss of gross profit is deriving from what you are able to produce compared to what you can produce if there was no loss. Then, of course, there's an increase in cost of working. What are the additional costs, expenses that you need to incur to recover the business? Yeah, this is what is payable under the gross profit. Then the next section of the specification actually tells us how is the amount payable, how we derive the amount, how we access the amount when there's a claim. Everything will be everything that we calculate is also always based on what is your reduction in turnover, how much your reduction in turnover, how much is your increase in cost of working. So we got to determine this to assess the claim. Then of course there will be less any amount saved, whatever there's savings, it will be less out. Of course, then last part is it must be subject to average. Every policy will be subject to average, so it is uh, quite important that the sum insured must be adequate. Yeah, this is a one page summary of what roughly what this particular specification is all about when you decide to insure loss of gross profit. Yeah, as a summary, this is what happens, but we will go through section by section how how this is derived, the details of the workings, how this is being computed, how claims is payable. Yeah. The first thing that we must know is your accounting gross profit and insurance gross profit is not the same. Yeah. The gross profit that you see in the accounting, the financial accounts of the insured is not the same as the gross profit that you want to insure under the insurance gross profit, which is the business interruption sum insured. Yeah. So it's not the same. Yeah. Please bear in mind, very important, not the same. A lot of times, there's always a mistake where the insured just use their accounting gross profit to say, this is my sum insured. It's not the same. Yeah. Why? It's not the same. Yeah. We go through it. In the accounting side, you have sales, then you have the less are all your cost of sales that gives you a gross profit. When you have the gross profit, you less all your business expenses, which your operating expenses and so forth, gives you a net profit. But in insurance, is sales, it is less cost varying directly with sales. We call it specified working expenses. That's a term, yeah. So it's different from cost of sales. It is cost verifying directly with sales. Yeah. What is the difference then? I give an example, which is here. Say wages. Wages is deducted from your accounting gross profit, cost of sale. All the wages is considered as cost of sale. But in here, not all your wages are considered as cost of sale. It's not called of not considered as insurance gross profit. Yeah, some wages will still have to continue to be paid. Example, I think I gave an example earlier where some of the staff salaries, you may still have to maintain the salaries of the staff to make sure the recovery is in order. Somebody has to do all that detail work. Some of the salesmen may still have to continue to what you call convince the customer to stay. They maybe they can have other suppliers to supply for them and so forth. This kind of salaries can still be payable under the insurance gross profit. But in here, the accounting gross profit is already minus all your sale, all your salaries and so forth. In here, it's not taken away 100%. Yeah, so it's slightly different. Your bad debts may be deducted here, but not deducted here because that debts can be. Not everything is bad debts. Not everything is influenced by the sales generated. Bad debts can be related to many other things. Yeah. Similarly, power cost is very directly with sales, but it's not part of cost of sale. Yeah. So you can see power is deducted here. All the power may not be deducted here because some of the power may not be considered as due to reduction in turnover. Example, you could have an admin office, the factory manager or mini office, the mini office may still be able to operate because it could be stationed in another part of the factory. It could be another building, administration building, which is separate from the main factory building. Therefore, your power will still continue. It is not a cost varying directly with sales. It is a mean function of the factory that will continue, and you still have to pay for the power in that particular building. So as far as accounting is concerned, the power is totally a cost of sales, but in here is not considered, everything is not considered part of accounting gross profit. Yeah. So there's a difference between this and this here. Yeah. So what does it leads to, If you choose this here, gross profit here, there's a high possibility of under insurance is based on accounting gross profit. Why? In principle, your insurance gross profit actually covers your net profit for standing charges. And some of the standing charges that we are covering here is already deducted in cost of sales because it is part of cost of sales as far as accounting is concerned. But the insurance, it is not. It is included as the item insured in your insurance gross profit. Yeah. So it's different. So it's important that your customer knows that you cannot just take accounting gross profit, the financial accounting gross profit as the sum insured. We will go through the actual definition of insurance gross profit in the next slide to look at how actually you calculate insurance gross profit. Yeah. But the message is accounting gross profit is not the same as insurance gross profit. Here are some examples of what is standing charge, what is specified working expenses. I have to show you this because in accounting, when you talk about standing charges in insurance, it's actually known as fixed cost in accounting terminology. Yeah, fixed cost is like your salaries, your advertising. You may still continue to advertise. It's a fixed cost. If you don't, all your sales will be gone. You must still continue to advertise in your billboards, in paper, in in radio and so forth to make sure your company stay relevant even after the loss. Your rental, you still have to pay rental, equipment, leases, you have to pay interest, loan interest, you have to pay, bad debts, you may have to incur, salaries, wages, you may have to pay, director's fees, you have to pay. These are called, in insurance, standing charges. In accounting, you call it fixed cost. Yeah. Then there's specified working expenses. This is actually the same as variable charges in accounting terminology. Variable charge is where you don't have to pay those expenses anymore after a loss because it actually reduced proportionally to a reduction in turnover. Meaning to say things like your purchases. Your purchases give you a discount, but you don't buy any purchases anymore because your purchases will not be there if your factory is not able to operate, or reduce if your factory can only partially operate. Your carriage, you don't need your carriage cost may be reduced because you cannot be sending goods anymore because you don't have goods to send to. Your packing materials, if your production is low, you cannot produce, you don't need any packing materials. Freight charges, you don't send things out anymore. There's no freight charges. You don't pay commission to people who are selling for you, So these are specified working expenses. That means this cost will not be incurred after your loss, or we know call as variable charges. So examples that I highlight to you in this particular chart, what you consider standing charges, what you consider specified working expenses. Salary, of course, is a standing charge. You may still have to continue to pay. Depreciation is a standing. You must still have to incur. Bank interest, you still have to pay. Purchases, you may not need to purchase things anymore because you cannot produce, so it becomes a variable charge. packing similarly variable, and so forth. So this is an example of able to 100% determine which falls under which. The example I give you is very straightforward scenarios like packing materials. Obviously, you don't need purchases. Obviously, you don't need anymore after the loss and things like that. The right person who actually can tell you or
Sekarang
identify.
bukan dia centralized kah? Bukan centralized kah? Hah?
Okay, sorry, there's a slight light disturbance somewhere. It's okay. So what I'm saying is that the accounting or the insured himself will be the right person to identify what are the standing charges, what are the specified way expenses as far as
Mr.
their
Yap, sorry
business
for
is concerned.
interruption. Can you reshare your slides? It's went to a
Gone
whole
again.
new. Yeah.
Gone. Missing again,
Yeah,
is it?
gone. Yeah.
Okay, okay. Can see?
Yes, you can see the slides here.
Just now I was here, right?
Yes.
I guess so. Anyway, okay. Just to repeat myself, this slide is to give you some examples of what are the standing charges, what are the specified working expenses. Yeah. As I said, me and you can only roughly uh, decide or guess what are the standing charges, what are the specified working expenses. The right person who can actually give you 100% accurate answer would be the insured. Perhaps the accountant of the insured will be able to tell you exactly what is standing charges, what is specified working expenses. I'm sure they'll be very familiar with what it means by fixed cost, what it means by variable cost, and so forth. Yeah. Here is only an example of what I think would be the standing charges and specified expenses, which are very clear items that we know lah. Yeah, basically lah. Something that I want to highlight is also those green boxes. You notice the green boxes has two ticks. What I'm trying to say is, for example, power. I already give you an example just now that it can be both, because if you are a factory, the whole factory is burned, you don't need to incur any more power. But in some situations, some power may be required to continue the administration work or whatever uh, in another building. Administration building may be another building next to the factory. That power is considered standing charge, right? So that's why I say is there are two things. Similarly, bad debts can come from your what you call sales. It can also come from other areas. Maybe you have generating income, rental income, or things like that somewhere else. Yeah, another income base, but not a factory. So it can fall under both. Your traveling expenses also can fall under both, because even after the loss doesn't mean you don't need to travel. You may still continue to your salesman may still continue to travel to also continue servicing your existing customers, to make sure they don't run away, they don't get supplies from the customer, to convince them that they should stay with you and so forth. So these are still standing charges, not specified working expenses. Yeah. So it can be both depending on how the insurer defines it. Yeah. That's why I say the insurer is the right person who actually can determine exactly what are standing charges, what are specified working expenses, or if they fall under both areas, what percentage of it falls under standing, what percentage will be under specified working expenses. They would be able to give you a gauge where it falls into, basically. Yeah. Okay, now we look at the formula for deriving a gross profit under the insurance gross profit definition. Yeah. Basically, what it says here is in this chart, where your turnover plus the closing stock plus the work in progress, you must less the opening stock plus work in progress plus working expenses. In other words, this element here, you must less all this, gives you the gross profit. And you note that we are now minusing out your opening stock with progress and minusing out specified working expenses. Indirectly, what are we covering? Actually, we are covering your gross profit plus your net profit. Gross profit plus your standing charges, your fixed cost, because you don't minus off your fixed cost here. You only minus off your variable cost, your expenses that will not incur after the loss. Yeah. So what remains is actually your gross profit plus your net profit. Actually, your net profit plus your standing charges. Yeah. Another version of how you determine gross profit, there's a simpler version which is in this manner. Net profit plus fixed cost will be a gross profit, or what I explained here in this manner. Most, I would say 99% of people use this basis, gross profit different basis, rather than use this basis to calculate your gross profit. Why I say that? Because here you got to determine what are the fixed costs. Yeah, your net profit plus your fixed costs. But if you have overlooked to include any one of them, that means you're not covering it. Yeah, so you may be underinsured in a sense because you did not name it here. But in here, you're only minusing out your variable cost. It's the other way. Yeah, it's the other way where you minus a specified working expenses or your variable cost, leaving all your standing charges behind. So here, chance of you overlooking fixed cost is minimized because you don't name them. You only manage your variable charge. Yeah. So chances of under insurance here is minimized in a sense lah. Yeah, you use this. That's the reason why majority use this to determine your gross profit. Yeah. But I can understand some of us may think, wow, this formula not very not so easy to compute lah. Well, I got to look at the accounts to do this to actually find out what are the numbers under closing stock, what are the number work in progress and so forth, what are the special working expenses to even come up with this. Yeah. We do not really expect us to actually look at it very in detail. We need to what you call provide an explanation to your customers that under the gross profit sum insured, you need to use this formula to derive your gross profit. I'm sure the insurance accountants will know how to do this once you give them this formula. Yeah, of course, we ourselves know this, and this we can have a gauge roughly how it works now. Yeah, but exactly what are the items that for classified as special expenses, the insured knows better. Yeah. Okay. I give you an example of how it looks like. When you look at accounting gross profit, you will notice this could be what you can see in your financial report. You got the sales 6 million, closing stock 400, work in progress 150. These are usually available in very straightforward available in your accounting. This is also very straightforward. The only difference could be this element here, where you have to decide what are these figures, and the accountant will be able to tell you what falls in their accounting trading account. This insured will have this 1950 as a gross profit. This one you'll find it in the financial reports in the form insured. Then from here 1950 gross profit, you then minus off all the other operating costs they will give you a net profit 670 in accounting. Is it available? When you look at the insurance accounting, you need to also look at turnover, which is the same as here, 6 million. It's all available in the house. 6 million is available, 400 is available, 150 is available. All the stock is this, and 300 opening stock, work in progress 400. These are very, very straightforward numbers directly from the accounts. The only difference is this. How do you determine this? Yeah, some of them are very straightforward. As I said, purchases very straightforward. Packing very, very clear. It is a variable cost and things like that. The only here may be a power, maybe the insured may decide how much power falls under standing charges, how much power falls under specified working expenses. So as an example, I use 60%. Yeah, that falls under variable charge. So it becomes 240. At the end of the day, when you use this formula, you'll find that your gross profit is 2760, and compare to the gross profit here is 1950. So if you just use the accounting gross profit 1950, in this example, you are actually underinsured by almost 41.54%. Yeah. So that could be the difference in between the business interruption, between the accounting gross profit and your insurance gross profit. Yeah. So the main difference is here, actually here, what you determine as specified working expenses. Yeah. Okay, so far, any questions before I move to the next slide?
No questions from our chat box, yeah, Mr. Yeah.
Okay, we move on to the next slide. Loss of gross profit. How do we calculate how much is the loss in gross profit? How do we calculate that? Yeah. Basically, it means we are applying a rate of gross profit to the reduction in turnover. Right? What does it mean? When you do a production base, you got a turnover, right? So basically, it means the rate of gross profit means from the turnover, what will be the gross profit that I can derive? What's the rate? Yeah. What is the, if I produce a million, what will be my profit that I earn from producing 1 million? What's the rate? Yeah. And in as far as business interruption is concerned, the reduction in turnover occurs during the indemnity period falls short of the standard turnover. I will explain this later in the next few slides, much clearer if I show you some examples in the following slides. Yeah, what it means here. Yeah. Before that, I'm going to go through exactly in a slide form, one summary page, what we need to do to actually decide how much is actually payable, how much claims is payable, how you compute the amount claimable, you know. So in this particular slide, what we need to determine, of course, remember we go through this. What is payable is the amount payable as indemnity shall be in respect of reduction in turnover increase the cost of living. Going backwards to a few slides earlier. Okay, just now I explained what is payable under gross profit, which we've gone through. This slide, you need to find out what is the actual gross profit that I need to determine using this formula and give you an example. Now, we are actually going to, once we have really know what is the gross profit they want to insure, now we want to look at how do we pay out when there's a loss. How do we look at deduction in turnover? What is the increase in cost of working? We are going to go through this item 2 here in the following slides. Yeah. Okay, how do you do that? This is taken from just now the earlier slide. Amount payable in respect of reduction in turnover in respect of increase in cost of working. What do we need to do? First, of course, we need to determine what is the rate of gross profit first. Then after that, we need to determine the reduction based on indemnity period, what's the annual turnover, what is standard turnover. We go through that afterwards. Then after we derive this, we need to look at other circumstances clause, which means we are trying to adjust the amount that is derived here as practical as possible based on the current environment. Remember, we are all now talking about future loss, a future reduction, because when there's a loss, the reduction will be the future, right? It's not talking about past, right? So unlike, as I said, unlike property, when there's a damage, we just pay the cost of the particular property that's lost. But in business interruption, we are looking at loss in gross profit. The loss of profit hasn't occurred yet. Yeah, it's the future loss of profit, future reduction in turnover. That's why you need this to adjust to as practical, as close as possible to what we predict the future will be lah. Yeah, so we need to do that. Not to worry again. This is just a one slide summary. We will go through item by item afterwards. Then we have to add what is the additional expenditures necessary and reasonably incurred to avoid diminish the reduction in turnover. We have talked about this many times just now, increase in cost of working, which is covered under policy. Once we determine what is this loss of profit, you also got to know what are the expenses that has been paid by the insured to do this. Yeah, it's also covered under the policy. Then after we determine this, then we need to look at less any sum insured, rather less any sum saved, right? Then subject to average. Yeah, we go through one at a time to explain to you how it works. First thing we need to know is what's the rate of gross profit. Example, just like I mentioned, when you have a turnover, you want to know from the turnover what is my profit. So there should be a rate involved. How do you calculate the rate? Is your profit over turnover times 100%, which is your profit 1.8 million, example. From the accounting, you find that your gross profit is 1.8 million out of sales of 7 million. Therefore, your rate is 1.8 million over 7 million, gives you a rate of gross profit of 75.71. Meaning to say, if I produce 5 million, I will most likely get a profit of 25.71% of my sales of 5 million. You have 10 million sales, I expect to have a 25.71% profit out of my 10 million sales. Yeah, that is your rate of gross profit. How do you determine the deduction? First, you must know the indemnity period. Indemnity period, you need to know how long you need to recover after the loss. Yeah, that means during this indemnity period, what is my reduction? How long do I need to recover? Then what will be my reduction during this period? Remember, we are talking about loss of gross profit due to what? Due to reduction in turnover. So how long is this period? How long is this period that we need to do the reduction? This is called indemnity period. In short, it also means how long insured needs to fully recover after the loss. How long do you need? It actually starts from the day that damage ends when business is no longer affected. That means the business is now or not assume its operation as normal. That's where indemnity period ends. A common criteria to use is when your turnover to pre-damage level without having incurred any increase in cost of working. ICOW is actually short form for increase in cost of working. Yeah. Now the question will be, how do I determine how long is my indemnity period? How long do I think the insured will fully recover after the loss? Again, Me and you cannot decide for the insured. We don't know the insured business. The insured know better after a loss of the particular occupation, how long they need to recover. Yeah. What we can do is we can only explain to them what you have to consider to determine the indemnity period, which is in this chart here. There are following factors that insured may consider before deciding what is the indemnity period. What is the availability of alternative premises? Like say, insurance company easily, they have already planned that if something happens, they have go to another site. But what about factory? They may not have, like the earlier example I said, they may have, because they may have another factory somewhere else. The other factory may double up for them to reduce the reduction. So for them who have other factories elsewhere, maybe the damage period will be shorter because they can recover from the site. But what happens if they don't have any other factory? They are the only factory, so your damage period may need longer time, right? Then after the loss, how long do you expect to rebuild the factory or make repairs to the factory? What are the raw materials that is available? Raw materials, sometimes some of them may take some time to order. So you also need to plan that particular timing. What's the lead time to replace or repair the machine? Some machines may be very, very sensitive, may need some time to rebuild, especially those prototype machines where you need to pre-order, pre-fab from the manufacturer. So it takes longer time. Then the other area they may need to consider is, will there be any subcontractor who can also do the manufacturing for them? They can outsource it to them. Yeah, that will also help to reduce their reduction in turnover. Estimate time to recover customers, because they may have lost some customers. How long, what time they need to, what you call, encourage the customers back to purchase their good products. Business is seasonal. If business is seasonal, you also take into consideration the seasonal period, because your timing of loss can fall after your seasonal or during the seasonal period. So you must know when is your seasonal. If you want to include your seasonal, then your indemnity period must fall within the seasonal period. Yeah. What is the time to reorganize the entire operation and manufacturing process? You need to time to reorganize. Manufacturing process may need to change and so forth. Yeah. So these are factors that may consider. Not easy to decide. As I said, even the insured sometimes is only a prediction, it's only an estimation of how long. But in most cases, I can see usually for factories, they usually is 12 months, easily 12 months, no less than 12 months. Yeah, less than 12 months is most likely services industries and so forth. Manufacturing usually on the safe end is 12 or more months. Some of them may even see 18 months. Yeah, 18 months to 24 months. But majority I've seen is actually looking at 12 months at least. Yeah. Okay. For indemnity period, sometimes, as I said just now, some people may choose 18 months. So if it's 18 months, you need to look at turnover more than 12 months. Your accounting is only 12 months. So you got to proportionate what, if you're taking 18 months, what will be your turnover in 18 months. That would be your basis to decide what is your turnover. If less than 12 months, you still need to take 12 months turnover. It doesn't mean that if I choose indemnity period for 6 months, I only take 6 months turnover. No, it's not. Why do I say that? Because you take 6 months, you may miss out the seasonal turnover. Example, during the seasonal turnover, the chances of the turnover may be much higher. Say Chinese New Year, Hari Raya, this 2 period of seasonal turnover is actually consists of maybe even 60% of the entire full year sales. So you only take 6 months, if your indemnity period is 6 months, then you are not including the seasonal turnover. Let's say your entire year's turnover is 12 million. So 6 months indemnity I 6 million. Yeah. But if your loss happens to be in a seasonal period, your turnover is not 6 million. Your turnover could be 8 million because during the seasonal, your turnover is much higher. Therefore, if you use 6 months basis, you may not be accurate because you miss out the seasonal turnover. Yeah, so 12 months will be the basis to look at your turnover. When you decide your gross profit, your 12 months turnover should be used instead of 6 months. Likewise, if you have more than 12 months, your turnover 18 months will be used instead of 6 months, instead of 12 months. However, if you choose a lower indemnity period, say 6 months, you are only charging 75% of the premium. Of basic rate means actually the total premium. Yeah. So if your total premium is 10 million, your indemnity period is 6 months, you're only charging 7,000. It's 10,000. Let's say 10,000. Your premium then will be only 7,500 instead of 10,000 because you only charge 75%. If it's 12 months indemnity, of course, it's the same 100%. You choose 18 months, there will be you only charge 90% of the premium that you calculated. Yeah, okay. So something that you should be aware. If you have 6 months indemnity period, you still have to take 12 months turnover. The reason, as I mentioned just now, you need to cater for the seasonal turnover. Okay, if we move on to the next thing that we need to know is the annual turnover. What is the annual turnover? Remember, we always talk about turnover here, 12 months turnover, and so forth. So if you are 18 months, you're going to take 18 months here, basically. If you're 12 months, you take 12 months. What's the 12 months annual turnover is? You're talking about what was the turnover immediately after 12 months, immediately after the loss. If the loss is here, for example, in this chart, is let's say this is November, okay? So what's the annual turnover? It will be up to here. That means 12 months period from the day of loss. What is the annual turnover here? Why we need to know this? Because we need to establish your sum insured, whether it's adequate or not, using annual turnover. Yeah. Period insurance could be here, loss is here. Your annual turnover will be 12 months prior to the loss, which is November to November. This 12 months is your annual turnover. Basically, we need to know adequate sum insured and also what is the standard turnover. When you talk about standard turnover, what it means? It means you choose an annual period to be in this period. Yeah. And this is the time loss is recovered. The annual period, this is the date where you're fully recovered. So your standard turnover will be looking at comparing to the same period where this falls. You can see from the chart, the annual period is here to the recovery period. What is the standard turnover during the period before is here. This is July to December, and this is also July to December. The same period of loss, or rather the same period of interruption. Standard turnover is the same period before the loss, which is the same January to December. Why we need to do this? Because we need to know what is your reduction in turnover. When you say reduction in turnover, we need to have a comparison, right? What do we compare to find out what's the reduction? You have to compare what was actually produced during the same period. Yeah. Otherwise, how do I know what's the reduction? How do we compare? We must know what do you produce during the same period, during this period of interruption. That should be your reduction. Example, if you're in this endemic period where there is a loss, your business is interrupted, you can only partially produce, and that production is only 1 million. But if you compare to this period, same period, you're able to produce 3 million. Roughly, I can produce 3.5 million last time. Because of the loss, I can only now produce 1 million. Hence, what is the reduction here? My reduction in turnover is actually 2.5 million. Actually, I can produce minimum 3.5 million if I don't have a loss here. Compared to this 3.5 here, I only now produce 1 million after the loss. So my reduction is now 2.5 million. There's a reason why I'm saying when you look at reduction in turnover, you must be able to compare to what? Compare to the same period where I was in production. Yeah. So in this example, 1 million against 3.5 million is 2.5 million reduction. Yeah. Okay. It's close to 10:30. I think it's now 10:25, something like that. We take a break. We come back at 10:45, and we will continue with next item, which is other circumstances clause. Just to recap what we have just done. Yeah, we are now doing this part here to determine what is payable. The first step you need to know, you must determine what is the rate of gross profit. You must then understand the concept of indemnity period, annual turnover, standard turnover, which you have covered. And when we come back, we will then look at how does this other circumstances clause applies after we have determined this. After we have now determined my reduction in turnover, I know how much my reduction in turnover, and how does this play a part in here. Yeah, when we come back at 10:45. You have any questions that's not clear, we can look at our questions after the break at 10:45, and we will explain to you as much as we can to your questions. We answer all your questions as much as we can, basically. If you still have any questions that is not clear, you still have anything that needs to clarify, please raise it after the break. Yeah, thank you. Okay, Alex, 10:45. We have looked at rate of gross profit. We have looked at indemnity period, annual turnover, standard turnover. So now we're looking at this, how this applies when we have determined all this. Yeah. Okay, other circumstances clause basically means we need to look at the amount which is as close as possible to the actual loss. This enables us to adjust figures to represent as may be practical the result which for the damage we have obtained during the relative period after the damage. Basically, what happens is that I mentioned that loss of gross profit, we are looking at your future profit. Yeah, when it's a loss, we are depicting what will be the loss of profit after the loss, which hasn't happened yet. Yeah. The earlier example that I showed you was actually looking into the financial accounts, the financial numbers from a account from a previous year's accounts, right? So it's already the past history, right? So now when you talk about the new current loss profit, is a prediction. So we need to account for various changes that could have happened during that period, during the future losses. What can happen? There could be a economic growth or economic downturn. Economic growth, suddenly there's a boom in the market, there are a lot of new orders, suddenly the turnover actually increased quite substantially compared to the last annual, what you call the standard turnover. Remember, we look at the standard turnover, we're talking about when we look at reduction in turnover here, we need to compare to what was the standard turnover to determine the reduction. Yeah. So in here, in this other circumstances clause, we need to consider whether there is a strong economic growth that maybe would have changed my reduction in turnover if there was no loss. It could have produced more than the standard turnover that we derived earlier, yeah, because of the growth. There could be a business trend that has improved. If there was no loss, my business trend should have improved more than my standard turnover. Yeah, because it could be I have bought some new machines and the capacity of these new machines will be much higher, right? I may have bought the machine just before the loss, and this machine is expected to produce, the productivity of these machines is expected to increase by a certain percentage. Yeah. If I have no loss, I will produce more compared to my standard turnover. I may have just launched this new products, and these new products will actually give me a higher turnover, expected higher turnover, which is not going to be what I produce in the standard turnover. It could be higher. So we also need to look at that particular trend and many other factors that could have influenced my actual production after the loss. Yeah, basically, in summary, it's just trying to say I'm very fair to the customer. I also look at what could be a possible trend that may have even allowed the customer to allow the insured to actually produce more than expected. Or it could be the reverse. It could also turn around and say because of economical trend, because of economic slowdown, the standard turnover will also be much lesser than what was produced last time. So it can be either way. But anyway, this particular clause is here to help to make sure that whatever we adjust is as practical as possible. Yeah. I give you an example. Let's say the loss occurred in April and recovered in July. That means the loss was April, May, June. July is fully recovered. So we look at here in the next chart. Turnover 2019 was 400, 350, 300, 400, 350, 300. Say now, I would expect during these 3 months, my production should actually increase much more compared to the previous year because I have actually bought some new machines. One particular line can produce 20% capacity more than last time, and so happened that particular production line was damaged. So I expect a 20% increase in capacity, for example, yeah. So my turnover 2019 was supposed to be 480 if there was no loss because my capacity increased. So my 350 was supposed to be 420. My 300 is supposed to be 360 if I used the new machine to produce. But the actual turnover was 200, 300, and 250. Yeah, actually because of the loss, the line was damaged, so the other lines produced only 200, 300, 250. So there's a reduction now. If I look at the reduction without the trend, without this 20% trend, I will have lost 200 in April. Your 400 minus 200 is 200. Your 350 minus 300 is 50. Your 300 minus 250 is 50. So therefore, if I don't consider that increase in capacity of your plant, of your line, I will have only reduction in 300. However, if I now consider the trend where I expect to produce 20% more, by right, I'm supposed to produce 20% more during that period. I'm supposed to produce 480, 420, 360. But because of that, my reduction is now 480 minus 200, actual turnover, 280 is the reduction. 420 minus 300 will be 70, and 360 minus 250 is 60. Therefore, my total reduction, based on the fact that my plant can produce 20% more, the reduction is 410. So with this circumstances clause, the reduction in turnover is no longer 300, it will be based on 410. Hence, if I use the same rate of gross profit 25.71, which we calculated just now, times your 300,000 reduction, you only get a loss. You get a loss of profit of 77,130. But if I consider this particular clause, 400, my reduction is actually 410. It gives me a loss of gross profit of 400. To be more practical, to take into consideration whatever trend that
Mr. Yap,
is
sorry, your
happening
slide's
during
gone
the period
again.
of disruption.
Mr. Yap, sorry, your slide's gone again.
Yeah, okay.
Can you reshare? All right, thank you.
Yeah, okay. Okay. Can
Yes,
see?
yeah, can see.
Okay. So as
I
I
can
was
see.
saying, as the other sequence clause is actually inside your gross profit specification. It allows you to make the adjustment based on the current trend of the business. Yeah. So it's a fair treatment to the customer where we also take that into consideration. It can go, as I said, it can go either way. It can be an increased trend, it can be a lower trend, depending on the situation. Yeah. If it's an increased trend, then obviously it benefits the insured. Yeah. So we take that into consideration. Yeah. That is other circumstances clause. Now, after we have looked at the circumstances clause, now we need to know what are the increase in cost of working that we can cover. Yeah, I think we have talked about this many times. It actually means increase in cost of working actually means what are the expenses that you incur to avoid or to diminish the reduction in turnover. It helps to reduce the reduction in turnover. You may need to incur certain expenses to help to reduce your turnover, to reduce the reduction in turnover. Yeah. What it means, basically, expenditures must be additional and reasonably incurred must be incurred for the purpose of avoiding and diminishing the reduction in turnover. The maximum amount shall not exceed the rate of applying to rate of gross profit to the amount of reduction that is. What that means to say, when you apply the rate of gross profit times your reduction in turnover, it must not exceed this amount. The increase in cost of working must not exceed this amount, right? If your sum insured of the sum insured is 300,000 gross profit, and you use the rate of gross profit times the reduction, yeah, so that will be the amount that this additional increase in cost of working must not exceed. Say, for example, of course, this also has an element of economical limit. Economic limit is to say your increase in cost of working is in total you incur 300,000, but to save gross profit of 400,000 is not economical because you are using 300,000 to save 400,000. Obviously, not logical lah. Huh? I might as well not spend this amount because sorry, it's economical because I spent $300,000 to save 400,000, so it's economical. So might as well spend 300,000 to save 400. Yeah, so it's okay. But on the other hand, if I spend 500,000 to save 400,000, it's not economical. Therefore, our increase in cost of living maximum you pay is 400 because the last item here says maximum amount should not exceed. But if your 400,000 exceeded your profit of your 500,000 exceeded 400,000, then you cannot pay 500,000 because what you're incurring is only 400. Therefore, you only pay 400. Yeah, that's why we meant by whether the addition in cost of working or increase in cost of working is economical or not. Yeah, this is how we determine whether it's economical or not. It's higher than your gross profit. Obviously, it's not compared to pay you the higher amount, obviously we have to pay you the gross profit amount. Yeah. Here are some of the examples what we consider as increase in cost of working, in short, ICOW. Example, I think some of the examples I already did mention in the earlier session in the morning. Yeah, some possible expenses, overtime work to increase production to maintain the turnover. Last time the factory may be working from say 9 to 9 a.m. to 9 p.m. right? But part of the factory is not able to produce because there's some interruption. Partially there was a damage to the factory. Therefore, they need to run overtime. They need to do 24 hours to catch up the production. Therefore, the overtime pay for the staff to work from 9 p.m. to say 9 a.m. Another 12 hours sleep, 12 hours shift, you need to pay the overtime payment. Yeah, so this is part of increase in cost of working. You may also incur additional rental to operate a temporary premise. That means you need to rent another place to operate. Yeah, so that additional rental is increase in cost of working. You may need to rent equipment to maintain the production. Maybe some of the equipments can be rented, so you may need to pay for the rental of this equipment. Your air freight, you may incur additional air freight to deliver stock. Maybe you have excess stock somewhere in the warehouse. You may now need make sure that these stocks are delivered to the customers so that the customers will get the order on time and not cancel your orders because you delay the delivery. Therefore, you need to have additional cost incurred, additional freight charges. You may also want to purchase finished products from other supplier because they are the same product, just that it's actually from another supplier. So we may ask the other supplier, or you may buy the products from the other supplier to meet your customers' orders. Of course, when you buy from another supplier, there may be additional costs involved. Yeah, it may be a higher cost than compared to what you need. Your cost of producing the product. Yeah, your cost may be only 10 ringgit per item, but when you purchase from a supplier also must make some money, so you may be buying at 12 ringgit instead of now 10 ringgit, but you're committed to sell the goods at 10 ringgit. Therefore, you incur additional 2 ringgit because you need to buy the same stock, same product at 12 ringgit compared to what you can sell at 10 ringgit. So your additional cost is 2 ringgit per item. So that is additional cost. You may need to do a temporary repair for the production first before you resume. Maybe a situation where you actually need to have a new machine, but the old machine that was damaged can still temporarily work for the time being, where you do some minor repairs first while waiting for the new order to come. Yeah. You may subcontract the work, the production to other suppliers. The other factories may be able to produce, so you may want to subcontract the production to other suppliers, where of course you need to pay extra for that particular supplier to provide the production for you. You know, so that kind of situation you will need to have incur in cost of working, where this is also covered under your under loss of gross profit. Yeah. Now the question is, remember just now in this slide, in the earlier slide, we talk about economical limit. Like this example, 500,000 to save gross premium of 400 is not about economical. Therefore, you only pay 400, which is the maximum that you are paying out in the policy. Your policy sum insured is only 300. It's only 400. What happens to that? Can I cover the non-economical limit of 100,000 in my earlier example? Yes, you can, as long as your policy has included this particular clause. We call it additional increase in cost of working. AICOW. We put the short form is called ICAO. The earlier one was ICOW, this one AICOW, additional increase in cost of working. The additional 100,000 can now be payable under this particular clause called increase in cost of working. This clause has to be included inside. It's not part of the specification. It is has to be included into your policy. Yeah. Okay. So we have explained the circumstances clause, how it applies. We have gone through how you determine the reduction, how rate of profit, how the indemnity period, annual turnover, standard turnover. Then you derive what is the reduction in your turnover. Then from there, they will be looking at the trend, your other circumstances that comes in to adjust the trending of the business. After you do all this, then you need to look at saving. What savings does the insured have before we finalize the figure? So we have done this. We have gone through how we determine the reduction in turnover using these elements here. Then we apply other circumstances clause that will come up with some numbers that we have. Then you add what are the increase in cost of working that has been incurred by the insured. After doing this, you need to then less what is safe. What savings has the insured had? Yeah. Savings. What does it mean actually? It actually means less any sum saved during this indemnity period. Charges and expenses payable out of gross profit cease to reduce. That means the savings have to reduce what is payable under your gross profit. Yeah. Must be also directly related to your interruption of your business. They must not be specified under your specified working expenses. Meaning to say, we are now doing a savings out of something that we are covered. Yeah. What is not covered, which is special expenses, you cannot have any saving because you're not covering it anyway. Something that you are covering it, let's say your fixed cost, and there's a savings on your fixed cost which you did not incur. Obviously, we do not pay something that you do not incur, right? It's like now saying, I have a property insurance, I cover equipment because it's under listing. I have another policy to cover this particular equipment which is under leasing company, under insurance A. Then in my insurance B, I cover all the equipment inside. Hence, the insurance company only pay one time, right? It will be contribution between insurance A and insurance B for that equipment. We cannot be saying insurance A pay for this equipment, insurance B also pay for this equipment. That will then end up paying twice to the insured. This concept is the same as this because when you talk about savings, you are actually saving something that you are covering. In this example, it's a standing charge that we are actually covering and that is covered under the policy. But it's a savings under this particular cost, then we cannot be paying you this savings because otherwise it will be paying you double. We pay for it, then savings you don't deduct. In other words, you save, but we also pay for your savings. Then it will be paying the insured double. So it's a similar concept like your property insurance. They have two insurance company covering the same item. We do not pay. Both sides also do not pay you. It's actually contribution. Actually, the amount paid is only one figure. Yeah. So similar to saving. I give you an example to make it clearer. Yeah. Example, I'm talking about electricity now, right? Remember electricity, earlier example, we talk about, where was it? Okay, we talk about electricity power here. We say 60% is actually not covered because you're minusing 60% of the power because it's a specified working expenses, leaving 40% of it being covered as a standing charge, right? So 60% is 250, 240, and 40% is not covered. It's covered under standing charges. 60% not covered. So if I use that example, right? So 40% of electricity is covered under the policy. If I use this example, assuming now electricity costs, right? There is an interruption from January to May. January to May, business was interrupted. My electricity cost was 40, 20, 35, 30, 40 during this period. But after the loss, what I pay now is 30, 10, 25, 25, 25, 115. That means I have a savings of 50,000 as far as electricity cost is concerned. I used to pay 165, but I now pay 115 after the loss, 50,000. Right? So you can see I have saved my electricity cost. I save 10,000, 10,000, 10,000, 5,000, 15,000. So in total, compared to what I used to pay and what I am paying now after the loss, I pay less 50,000. Yeah. But out of the 50,000, 40% I cover, right? 40% I cover. I cover under a standing charge. Therefore, I got to proportionate my saving. 40 over 100 times 50,000 is 20,000. So what it means is that I have a savings of electricity for 20,000 for the standing charge that I am actually covering you for 40%. Yeah. So you had your proportionate out. So since 40% electricity was not used and classified as fixed cost, thus reduce the payable gross profit. Meaning to say 40% over 150,000 is 20,000. Hence, if I use the earlier example or trend, which is this figure here, is this figure here. So I actually have a loss profit of 105,411 that's payable. But because I save electricity, which is actually a cover under the policy, I have to minus out your savings 20,000 here, and the actual loss profit that the insurance company is going to pay you is now 85,400 because you saved 20. If we still continue to pay 105,000 here, that would mean the insurer is getting double because what is covered, he also saved 20,000 here. So we also pay you 20,000. So there is actually double, right? The insurer has saved double. I pay you 20, you save 20. So the insurer is enjoying 20,000 more payment in the sense, yeah? So as I say, it's the same concept as a property insuring by company A and company B, where both also pays you. That means you are getting double. Same likewise here. If I pay this amount, I pay this 105 amount, and the savings of 50 because of proportional, 40% is standing charges. Proportionally out is 20,000. So I save 20,000. Therefore, I need to minus. Otherwise, the concept will be that the insured is getting double. Yeah, 20,000 more for the insured. But remember, insurance payment is not for the insured to benefit, but we are paying. Insurance company pays you what you have lost, not gaining from the insurance. Yeah. So the same concept is that. Okay. The last part we are going through is the sum insured adequate? We are looking at this part here. We have gone through all this. Now we have minus out what is safe. Then now we got to check whether average will apply or not. Whether the sum insured is adequate. If poor average will apply. If not, average will apply. Okay. Again, remember when we look at the numbers, when we look at how we derive the the gross profit, we are looking at financial report, the latest financial report. It was the previous year's financial report to determine the numbers. Yeah. Then we determine the company's specific loss working expenses, which is the formula here. What we use, all these numbers are talking about previous year's financial records, yeah, historical. But if you look at the endemic period, let's say you 12 months, that means 12 months endemic period, that means you're looking at the future, right? The future of gross profit that the insured may generate. Hence, you need to project annual turnover for the next 2 years, right? Otherwise, this may here the what you determine here may not be sufficient because this is historical. Yeah, you are actually covering future, so you need to do projection of the next 2 years. We will explain to you why we have to take 2 years. Yeah, one of the main reasons is because a loss can occur anytime. It can even occur on the very last day of expiry date, and because of that, your numbers generated here are basically will be 2 years ago. So that's why we need to project 2 years. Yeah. It could be your projection could be because there's inflation. Yeah, when there's inflation, everything goes up. Your profit also may be different because of inflation. Uncertainty of business, your economy, your competition may have impact the future profits and so forth. So all this has to be taken in consideration by the insured when they look at the actual sum insured. What do I mean? Yeah. Remember this particular slide? This is taken from slide 25. We computed and say that the gross profit based on the formula was 2.760 million. That these numbers, remember, are historical numbers. Yeah. So if you take this number, you are actually insuring a historical number. 2.76 million is history. Yeah. So if we look at the gross profit from the accounts and computed using the insurance formula, you get 2.760. Right? Remember 2.760 here. But then, assuming you are purchasing an insurance in the year, sorry, this is 2022. In the year 2022, what your 2.760 is 2021, right? Right? So your numbers is 2021, but now you are buying insurance in 2022. Shouldn't the insured be now taking into consideration what will be my expected loss of profit in 2022? Your 2.762 computed was in 2021. So the insured must then have to decide whether they need to do a projection that your profit may be more or less than the previous year, right? So now I say, as an example, the insured says I'm projecting that in 2022 my profit will actually goes up by another 10%. So we may have to put an element of 10% additional for that year's profit, 2022 profit. So when you do that, becomes 3.36 million. Yeah. Your insurance purchase 2022, which means to say your policy is running from 22 to 23 period. So which means in 23, I now predict only 22, but my policy runs into the year 2023, right? Because your period of insurance is 22, 23. So I now got to take into consideration what would be my expected profit in 2023. So have to do another assumption for the 2023 projection. Now the insurer says, okay, 2023, I think we will have a 15% increase, yeah, of profit. So you need to add another 15% from here, you get 3,491,400. Then you got to also take into consideration that the fire can take place in 2023, right? Say fire happens in middle of 2023, your policy runs until middle of 2023, and so happens, so bad luck, your fire happens at the end of the policy period in 2023, and you take 12 months to recover. When you take 12 months to recover, profit goes into where? The profit will then runs into the year 2024, correct? So I explain here. Then you need now predict 2024. What is projected production in 2024? So you say, okay lah, the insurer will come back and say, okay, my 3 years plan by 2024, I will have another 10% profit. So you add another 10% profit, 349,140, and the final figure will be 3840540. Right? So your final sum insured that you need to insure after taking into consideration what the insured has projected his growth over the next 2 years. So your gross profit becomes 384,540 compared to the historical gross profit that we computed 2760. Always remember, whatever figure that you have used the formula to compute is a historical figure. The insured may have to think about the future profit as explained here. For simplicity, you look at this diagram here. You're looking at accounting period of 2021. Okay? In 2022, you need to predict what is the projection. Your policy inception is middle of 2020 in here. Policy inception 1 year until 2023 here. Right? This period of insurance is here. But then it runs into 2022-23, 22-23 period policy insurance. What happens when fire is here? Right? 2023. End of 2023. Then you need 12 months to recover. So where does it lead you? You only fully recover in 2024. So your loss of profit is actually talking about profit in 2024 as well. Correct? Right? Although you are insuring it for 2022-23 period, your loss can happen to the very last day of the policy in 2023, and 12 months to recover goes into 2024. As you can see from the chart, from a 2021 account that you use, your loss actually occur here and will run into 2024. So your prediction is 2022, 2023, 2024, 3 years prediction. Yeah. Another scenario could be your loss actually happens in 2022, immediately after you purchase the insurance 2022. So your loss will actually run in 2023. Then you don't need 2024, right? So you may only need 2 years. However, as I said, you do not know when the fire will occur. If your fire really occur in 2020, fine. Then you can predict up to here is fine, is okay, 2 years. But fire can occur anytime. Fire has no eyes. There is no crystal ball for you to see when the fire will occur. It can occur last day. If last day here, you need 2024. But let's say you only predict 2022, 23. But actually happens here. Then you are missing out projection of 2024. So you will be underinsured. Yeah? Okay? I hope that's clear of exactly to minimize underinsurance, the insurer needs to do a prediction of the future losses. Yeah. Instead of just considering the financial year, which is the historical number. Yeah. Any questions so far?
Mr. Yap.
Yeah.
Okay, your period of insurance ends wrong place.
Ends wrong place.
Should not be the green lines between 2023 and 2024.
The 2024 is starting somewhere here.
No. Okay. The period of insurance should end before 2024. Because you see, your period of insurance is more than 1 year already.
Yeah, correct. So I should have another line where the 2024 starts basically. Maybe I should have another line starts here.
You
Yes,
period
I put another line blue
before
here.
no. Before the green line. The period of insurance should end before the green line.
Which green? This green line, is it?
Yes. Before that. Otherwise, more than 1 year. Your period of insurance begin in somewhere in 2022.
Yeah, correct.
But you end it on I think the last day of the 2023.
Okay, maybe lah. Perhaps the line is not very clear lah. Yeah.
Okay.
So perhaps this line here, my period of insurance, I say end of tour period in this chart is not end lah. Is somewhere in 2023 lah. Right? It's somewhere in 2023. So it takes 12 months to recover somewhere here. So I'm saying to make it more correct, maybe this one is shorter a little bit lah. This is shorter a little bit here.
Yes.
Then I should put another line here to indicate the start of 2024 lor.
Yeah.
Right? So maybe my chart, this is, as from the chart, it looks like it's very long lah, but actually it's meant for 1 year lah. This line, maybe I should put it somewhere here.
Yeah.
Yeah. Then I put another line here to indicate the beginning of 2024 lah, basically lah, right?
Yep.
Okay. Okay. Thank you for highlighting this. But I hope it still gives you a picture of how you should project the sum insured lah. Yeah. Is that okay?
Okay. Thank you.
Okay. Thank you for highlighting. Okay. Any other questions?
No questions yet, Mr. Yap, from a chat box.
Okay, we move on to extensions and clauses. Yeah. In any other policies, like any other policies, there will always be extension, there will always be clauses. No different when you talk about business interruption. We just highlight there are 4 extensions that is available under the business interruption. One of them is specify suppliers and customers. The other one is prevention and access. The other one is public liabilities. And the 4th one is infectious and contagious disease. When you talk about specify suppliers and customers, it all relates to the insured supplier and customers' premises. We are not looking at the premises of the insured. It's looking at losses happening in the insured suppliers and customers' place. Yeah. And any loss in the customers and suppliers' premises that result in a reduction in turnover of our insured. Basically, that's what it's trying to cover. There are a few elements here. One, you talk about unspecified suppliers' premises. You will notice there's unspecified and specified. Unspecified here means you don't have to name the suppliers or the customers into your policy. Specify means you have to name the customers into your policy. Your customers and suppliers must be named inside your policy. But if you only want to cover unspecified suppliers, then our is limited to those located in Malaysia, Singapore, and Brunei. And this particular unspecified suppliers can only be extended provided you also cover specified suppliers. That means you must include specified supplier first, then only you are allowed to extend to cover unspecified suppliers, right? There's a limit to it. It will be 10% or 10 million, whichever is lower. Yeah. This should be is it's not over. It should be is lower. Yeah. 10% or 10 million, whichever is lower. There's excess of 72 hours. Then you have specified customers and suppliers premises. You must then name the customer and suppliers in the premises. It's also limited to location in Malaysia, Singapore, and Brunei. But this time, the liability of each customer and supplier is now subject to a percentage limit on sum insured. That means to say, if you, in your policy, when you do a specified supply, you must also indicate what is the percentage of what you call, what is the percentage that will influence that will impact your turnover. Say, for example, supplier A have an impact of 20% of my turnover, right? Or your customer has a 10% impact on your my turnover. Hence, sum insured will be based on what you declared, what the insured declared. If it's 10% impact customers turnover, then your sum insured is 10% of your sum insured. Sum insured is 1 million, then you cover 100,000 for your customer. If you say the customer will impact me 10%, right? So it depends on the percentage that insured declare on the what you call what on the impact to the customer's turnover. Again, time excess is 22 hours. Yeah. There is the policy does not allow you to cover any unspecified customers. You can only cover unspecified suppliers, not unspecified customers. But you can cover specified customers. Yeah. Second extension that we are looking at is prevention of excess. Basically meaning to say, if in the vicinity of the insured premises, there is a prevention by maybe authority to enter the premises, enter the particular area. Perhaps it could be it could be incident where there's a riot in the particular factory, to do investigation to make sure of the safety of all the properties inside within this vicinity. The authority may actually condone off the area. Although the strike doesn't happen to your factory, it happens to your neighbor. So there was a strike in your neighbor, the authority comes in, condone off the area for maybe even a month to make sure all the people are safe, to make sure there won't be any further incident, So it's condoned off, so your factory cannot operate, and hence there will be a reduction in your production. That kind of reduction, if you extend to cover this, it will be allowed. It will be payable, but the limit is of course 10% of sum insured of 10 million, whichever is lower. Excess is 72 hours. The third extension that you allow is public utilities. There will be factories that rely on electricity or maybe water or maybe gas to operate. Failure of obtaining the electricity, failure of water supply or gas because of an insured peril. That means it could be a flood happening in the supply station of TNB, your substation, so you cannot produce, and the flood may last for a week or two, I don't know, depending on circumstances. Or there could be the gas supply, the gas main supply station of the gas has a fire damage. There's no gas supply, and you rely on the gas to do your production, and hence there will be a reduction in your turnover. You extend that kind of loss, that kind of interruption resulting in loss of turnover is payable. Time excess 72 hours. Normal time excess 72 hours, but you want the time excess to be lower. You want it to be 48 hours. There will be a 50% charge, rather 50% loading. And you want to do it 24 hours time excess, there will be 100% loading. You also allowed to opt to select which utility you want to cover. It can be one, it can be a combination of two. You want to cover only electricity possible, only gas can, only water can, or you want to do combination of two. Perhaps you may need electricity and water because both of these are required to for your production. Yeah, so you can choose to decide which utility you want to cover. The last one we're talking about is infectious and contagious disease, murder, suicide, pest, food, and drink poisoning, or defective sanitary. Before COVID-19, this is the norm that you can actually extend. What does it cover? If there is an infectious disease occurring in the particular premise, hence the authority may come in, may need to do the inspection. You need to make sure all your staff are not infected. That would take maybe 2-3 weeks. Your factory cannot operate for at least 2-3 weeks. And there will definitely obviously be a reduction in turnover there. Yeah, it could be a murder or suicide or pest occurring in the premises. If it is a murder or suicide, the authority may also prevent you from operating because they need to do investigation. The investigation may take some time. If there's a pest, the authority may also ask you to close down for the factory until they're satisfied with your pest control. Make sure the pests are no longer present, especially for food industries. You may ask you to close for 1 week, 2 weeks until they're satisfied. Or maybe there will be an illness because of food poisoning. There may be defects in the sanitary arrangement of the premises that needs also a lot of cleaning, takes and restrict your operation. So if that's the situation, this particular extension will also cover loss of gross profit. Then comes COVID-19. When COVID-19 comes, was actually at the peak. That means a lot of death and things like that during the initial stage of COVID-19. This particular extension, infectious and contagious disease, has been removed because all the reinsurers has back up and decided to withdraw this cover. Hence, the infectious contagious disease under this extension has been removed, no longer able to cover even until today, and is now renamed as only murder, suicide, pest, food and drink poisoning or defective sanitary. The word infectious and contagious disease is no longer appearing, and the first item here is no longer in your cover as long as this is extended. This particular extension doesn't cover any type of cleaning, repair, replacement, recall, or checking. What it only covers is your loss of gross profit. It doesn't cover your cleaning cost, doesn't cover any repair cost, doesn't cover any replacement cost, or any recall or checking of the premises. You need an indemnity period for this policy, for this particular extension. Why we need it? Because your original indemnity period under the policy may be 12 months, but obviously for this to happen, you may not need 12 months, you may only need 3 months or so. As an example, so usually it's much shorter period than the standard indemnity period appearing in your policy for loss of gross profit. Therefore, you need a different indemnity period for this, and your limit is 10% of sum insured or 10 million, whichever is lower. Excess is 72 hours again. I mentioned here there is a new additional clause to strengthen this exclusion, usually imposed most of the time imposed by the insurer using this wording LMA 5393, which I'm going to show you in the next slide. This is another wording that when you read it, you may not quite understand. Basically, it's trying to say that any type of contagious disease will not be covered. you're not only restricting the COVID-19 type of disease, any disease that is communicable disease will not be covered, and this kind of disease can be transmitted by airborne, can be by bodily fluid, can be by any surface object, meaning you touch any object where the virus has stayed there, you touch the object, you will transmit it to you from solid, from liquid, from gas, or between organism. That means from blood, from a bird to human, and so forth, will not be covered. In short, any type of contagious disease will not be covered. Yeah, basically that is the current wording that most insurers are using. Yeah, it is total exclusion for any contagious disease. Yeah, okay. This is the 4 extensions that is available under business interruption insurance. Any questions on these extensions?
Mr. Yap, can you
Yeah.
elaborate what the time access works?
Again,
What the time access
your voice is breaking up, so I cannot actually.
Okay, can you elaborate how the time access works?
Okay, understand. Okay. Time access is very similar to, let's say, the deductible where it's a quantum ringgit. Yeah, let's say ringgit 10,000. The only thing is this is in hours, in the sense that the first 72 hours after the loss will not be covered. What is covered is only when the loss lasts for more than 72 hours. That means if the interruption was only for 72 hours or less, then policy will not pay. Policy will come into play only if the interruption is more than 72 hours. That means to say, if your interruption was for 90 days, then the policy will come into play and they will be covered. If it's less than 72 hours, it will not be payable. It is not. Then it's not covered, basically. Yeah.
Regardless how if less than 72 hours, regardless how substantial the damage also cannot claim.
Yes, you cannot claim.
Okay.
So
if the
is that okay?
If the claim is payable, well the claim will deduct the excess.
No, there's no excess. The excess is actually the time. That means whatever interruption there is, I will not be paying you if the interruption only lasts for 72 hours or less.
Who will determine the time's excess? The adjuster.
The adjuster will go in and say, how long is your factory was not able to operate? Basically, is that lah.
Okay.
Yeah. So
Okay.
as you said just now, you mentioned however significant loss it will be lah. But put it this way lah. Yeah. This you are covering loss or gross profit. Yeah. For 72 hours, I do not think for 72 hours there will be a significant loss of gross profit lah, because you're talking about 3 days profit. Yeah. So to me it won't be that significant in the sense lah. You know.
Okay. Thanks.
Okay. Any other questions? No, I will proceed with clauses. There are 3 major clauses I think the policy should include. Yeah, I explain why. The first one is material damage proviso waiver clause. I believe most of your policies or most of insurer will actually include this for you. Basically, it's a benefit to the insured, where it is just to say that you must ensure that there must be an MD policy involved, and to ensure that claim is payable if MD claim is within deductible. Meaning to say, If we look at the wording again, I will highlight the wording. Where is it? Okay. Look at the summary is better. Yeah. Okay. Main point is claims under fire material is paid or liability admitted. So it's paid. So what happens when you have a deductible? Yeah, say flood. Because nowadays some insurance company impose higher flood deductible when you are in the flood prone area. Perhaps maybe the deductible could be 200,000 ringgit, because there were many incidents of flood there. So the insurance company said, hey, okay, the first 200,000 is the deductible. Insurer has to pay the 200,000 deductible first, which means to say the fire policy is not paid, because let's say the flood damage is only 100,000, your excess is 200,000. So that means the policy is not paid. Liability not admitted because is within the deductible, so insurance company don't pay anything. But under this definition, it says here must be paid. Then only there's an interruption, right? But in this case, there's no payment at all. So which means if you solely look at this, not payable. The business interruption not payable because you didn't fulfill the condition of paid and liability admitted. So no cover. But you have added this clause inside, it has forgo that kind of condition. Yeah. So you have this clause included, then you will forgo that condition, meaning to say you will also be payable, even though it's within the deductible. If there's still an interruption and the material damage policy did not pay because of deductible, not because it's not covered. If it's fire material damage is not covered at all, it's an exclusion, then obviously it is business interruption also won't be covered. Yeah. So it must be a period that is covered under the fire policy, but not payable because of certain things like your deductible. With this clause, it's still payable under business interruption. Yeah. So I think most insurance company will added this inside a policy. Anyway, yeah, I have seen business interruption policy. Most of it will have all included this clause anyway. Yeah. If not, then just make sure it is included lah. Yeah. Upward adjustment. Upward adjustment is also important to have because it minimize the avoid under insurance. Yeah, it just basically says it allows additional 25% more of your sum insured. One of the main reason is because remember just now earlier we talked about projection, right? Even you may have projected 10%, 15% or whatever amount that the insured decides. That is a projection. That is a projection. You do not know whether the projection is accurate. Maybe they didn't take into account the fact that suddenly there were many new customers that they able to new customers that they have engaged, yeah, without them knowing. They didn't predicting, they didn't expect so many new customers to come in, so their projection may be lower than what is actual production. Yeah. So with this outward adjustment, you allow another 25% adjustment of the sum insured that they have declared. Yeah. So it helps them to minimize in case this kind of situation occurs. You never know. You don't know. Yeah. To be on the safe side, you put this clause inside to safeguard the insured from having a average under an insurance. Of course, there will be a premium charge for it. It's 75% of outward adjustment as provisional pay. That means to say the 25% extra that you predict, you have to pay 75% of it. Yeah, basically is that. But not to worry, doesn't mean you are going to pay additional premium at the end of the day, because they will be adjusted back when the final accounting figures comes out, or audited account comes out. You can make an adjustment to see the actual gross profit sum insured that should be applied. Then there will be a premium adjustment back to the insured. If there's over predicted, then it's a refund back to the insured. You know. Then there is the premium adjustment clause. This one you don't have to worry whether it should be included or not, because it's already part of the specification. It's already inside the specification. I want to just explain to it so that you will not overlook to do it, because I find that a lot of times when the customer has a business interruption policy, chances are they may not look at it to do a premium adjustment. They just continue to renew without looking into this particular adjustment that is being allowed under the specification. What it's trying to do is that, again, is a prediction, right? Whatever loss of profit, gross profit sum insured is a prediction of future, so that when the actual result comes in, you also may be able to do adjustment. You may not be what you insure, it may be lower than what you insure. When the actual result comes in, so there can be adjustment on the premium that is allowed. Yeah, after we have the final audited accounts, we can look at that, and the insurer will then compute based on the same formula that we have gone through just now, the definition formula for gross profit, using the same formula, applying on the actual results, and we look at what is the sum insured. If it's higher, of course, there will be additional charge. If it's lower, there will then be a refund premium. But the maximum that insurance company will retain is actually 50% of whatever is paid. Yeah. So again, it's important that material damage provider waiver clause should be included in your policy. Our adjustment, it is good to have to allow the customer to have additional 25% more. Premium adjustment is something already in your specification. Maybe a lot of people have overlooked to use this for adjustment. You can always ask the insurer to recompute using the final accounting numbers to readjust back the sum insured, and there will be a refund if it's overinsured. Yeah. Okay. 3 major clauses that you should know should be included. There are other clauses as well. We will go through it one by one briefly. Accounting clause allows insured professional accountants to provide any particular details contained in the insured books. Meaning to say, if the professional accountant of the insured says this particular item is meant to be that way, then insurance company will take that as a correct version of what it means. Yeah. Payment of account clause also quite important to have. It helps the insured to recover. Basically, is allowing the insurance company to pay partial payment first. Yeah, in the sense that once the insurance company knows that this is a genuine claim and is payable, it's just that the amount has not been finalized yet, because you do not have the actual deduction in turnover. There are some adjustment that needs to be made. The savings cannot be computed yet until the end of the period. But obviously, the insurance company knows roughly the amount payable is so much, no less. So what they do is insurer can request for a partial payment so that they can have some funds to recover the business. Yeah, so it's a partial payment as long as the insurance company already know that there's a certain amount but needs to be further finalized later. But certainly there's an amount that needs to be paid and we do a partial payment first to help the insured. Yeah. So it's definitely good to have payment of account clause for the insured or have some partial payment. Departmental clause is like if the company has separate accounts, separate trading result, or rather separate accounts by department. So may not be usable.
Sorry, Mr.
for-
Yap. Need to reshare your slides, yeah.
Okay. You okay?
Yes.
Okay. So as I was saying, departmental clause is only meant for insured where they can actually have the independent trading results by department. Yeah, if you have, then you can actually adjust the claim amount using that department's trading results. Yeah, but this is only applicable where you really have different accounts. Yeah, for every department. Alternative basis is talking about turnover or output. That means to say it depends on what is more favorable to the insured, whether you use turnover or whether you use output. Turnover is talking about turnover when what's the cost of those goods that has been sold. Output is talking about manufacturing cost of the particular good. So it's different amount. Turnover is the cost of the sales. What is the sales amount that you generate? Output is talking about cost to manufacturing the goods. Yeah. So depending on which is more beneficial, which number is more beneficial to you, to the customer. So this clause is basically that lah. Yeah. So if turnover is more beneficial to the insured, then we use turnover. If output is more beneficial to the insured, then we use output. Yeah. So depending. Yeah. But most of the time, we is talking about turnover lah. Yeah. Usually, its turnover will be better lah in most situation lah. Yeah. But you want to put in this clause, there's no harm. It's just looking at options to benefit the insured. Yeah. This is independency clause is talking about joint insured, where there is a direct impact to a joint insured, where say they are related. Say a insured is producing a raw material for the use of a joint insured, which is B, right? A, B. They produce this to supply to B. If something happened to A, because supply has altered to B, therefore B will also suffer. In that case, the policy will also pay for any loss of profit on B, on the subsidiary B. Yeah. So this is allowed only if there is a relationship between parent and subsidiary. That means one subsidiary can be produced something for the other subsidiary to produce, and something happened to one subsidiary impacted the other subsidiary. Under this clause, that subsidiary which is impacted, although there's no loss, will also be considered as loss of gross profit if that's the case. Yeah. Salvage sales clause is when there's a salvage sale, that means you do not include the salvage sales as part of the reduction in turnover. Basically, is that. Yeah. Accumulation of stock clause is to say you have a buffer stock. Say, for example, you have excess stock in one warehouse, and you use this particular stock to cover up the loss in reduction in turnover. Here it says that would not be taken into consideration to actually do the reduction, because buffer stock has reduced the reduction. Therefore, this buffer stock would not be considered as part of the reduction. That means don't include this particular buffer stock that helps, so it's not part of a reduction in turnover. Yeah. New business clause is meant for business where it's just newly operating. You don't have a 12 months account. You only started a few months ago, therefore you don't have a profit. Whatever numbers that is taken is not talking about 12 months. It's talking about whatever months that you are operating. The numbers are based on particular those months only. Basically, it's for new business. The title of the clause is already very straightforward. New business clause, only meant for new business where you don't have a 12 months account. Okay, I've gone through all the clauses. Any questions on clauses?
No questions. Yeah, Mr. Yap.
No questions. We will proceed further. We now move to the last session. We are talking about how do we rate a business interruption policy. Yeah? The basic formula, of course, is your premium from your fire material damage policy over your total sum insured of your fire material damage policy. That will be the rate that you charge. But don't forget, that premium should not include the following. If there's a stock declaration in your fire policy, you should not include the premium in the stock declaration. Escalation clause, you shouldn't include the escalation clause. Reinstatement value basis, day one, there's a additional premium charge there, but that also, the additional premium charge for this particular clause were not included. Voluntary deductible, if you choose to have a voluntary deductible, of course, there will be the premium will be slightly lower because you choose a deductible, and that deduction of premium should not be part of the total premium. That means you do not include this particular reduction in the premium. Yeah. So these four elements you must not include using that formula, where it is the premium from material damage policy divided by the total sum insured of the fire policy. This premium shouldn't include any reduction or additional premium charge if the fire policy has these extensions. Yeah. I'll give you an example. Earlier, or rather in my previous session on fire material damage policy, I give you this example where you have an escalation clause here, 10% escalation. If you include the escalation premium, additional premium, you actually get a premium of 35,242.20. But if you don't include this escalation, your premium is actually only 33,564. When you talk about the rate chargeable under the business interruption, you don't use the premium of 35,000 here because escalation clause should not be included. So you have to use the premium of 33,564 over your 12 million sum insured in the fire policy, gives you a rate 2797, and it is not using 35,242 over 12 million, it gives you a rate of 2937. So you're not using this. You must exclude escalation, which is 33,564. And if your sum insured, gross profit sum insured is 5 million, then 5 million times the rate gives you a premium of 13,985 ringgit. Yeah. So remember, your premium for fire material damage should not include these four extensions where it can be an additional premium or is a reduction in premium. Yeah. to exclude this premium to compute. What happens if the con loss covers more than one location? One con loss policy can cover 2-3 locations because there's only one particular account that covers 2 locations, because there'll be factory A, factory B, one in Penang, one in Klang, Klang Valley, So there are 2 locations. You may opt to buy only one con loss policy because you only have one policy, one account for 2 factories because it's producing the same thing. So what will happen? How do I charge then? Con loss policies premium will depend, we call it average base rate basically. How it works is the total premium for all your locations, fire premium for all your locations, combined premium over the total sum insured for all the locations. I give you an example. Just now, we have taken 33,564 because you exclude escalation. Now, there's a second location that the insured has produced the same thing, maybe in another location. So that premium is 8,974.70 cents. Yeah. So one con loss policy covering 2, how do we charge? We take this premium plus this premium, becomes 42,538.70. This plus this, 42,538. Total sum insured of these 2 locations is 12 million plus 2.3 million, which is 14.3 million. Therefore, your basic rate is your total premium 42,538.70 divided by your total sum insured 14.3 million, gives you a rate of 2,975. If your sum insured is 5 million, 5 million times this rate will become 14,875. So this will be your average base rate, taking into consideration total premium for both locations, excluding any additional premium relating to these 4 extensions, divided by the total sum insured of both locations combined, gives you this rate. Then your sum insured times this rate will be your con loss premium, your business interruption premium. Of course, we talk about extension. If you added some extension, you have included some extension, then this will be the rate for the extension. If you're covering only fire and lightning, 10 cents, let's say specified suppliers. If you're covering perils as well, if your fire damage policy has perils, you may cover strike right. No matter how many perils you cover, maybe you only cover 4 perils: strike right, explosion, what else? Flood, windstorm. You need to add 0.05. So total premium, you cover fire, lightning, and perils, it will be 15 cents. 10 plus 0.05. Let's say public liability, public utilities. Just now I mentioned you can opt to cover any one of them. If you buy one utility, it's 0.01 plus 0.01 for perils. You have 2 utilities, it's 1.5, and you cover all the utilities is 0.175 plus 0.175. Yeah. You cover murder, suicide is additional rate of 0.01. This is base rate. You extension, you add this extension inside. And if you're covering specified customer suppliers, the rate will also depend on the dependency. Dependency, just like I mentioned, how much impact will this have to the insured? It could be a 50% impact. That means if there's a fire in this particular supplier or customer, the impact will be 50% will have impact to my turnover is 50%. Then your rate will be times 50%. In this example, if I talking about supplier customers, the rate is actually 15 cents. Remember, specified suppliers 10 cents, 5 cents is 15 cents. So it's 15 cents. The first customer, the most influential, most dependent customer, 50% will be 100%. The next most dependable supplier customer will be 25%, will be 50%. Your dependency is 25%, so you times 25%. If the next customer, next highest customer is dependency 10%, you only need to times 25%. 10% times 25%, and that would be the kind of rate that you charge for in each and every customer, depending on the dependency or impact to the turnover, and also on the reducing scale as to the percentage of impact. The highest impact 100%, second highest 50%, third highest 25%, and so forth. Remember during the extension I mentioned, if you want to cover unspecified supplier, you must cover specified supplier. These are specified suppliers, yeah. So you must also cover specified. You're not to buy unspecified. So it's unspecified supplier. The balance of what is in your supplier here is total 95%, right? 50, 75, 85, 90, yeah. So that means unspecified supplier, there's 5% impact. That's the reason why, in order to buy unspecified supplier, you also have to buy suppliers. So when you do that, the total here is 95. The remaining dependency will fall under unspecified. It's now 5%. So if that's the case, you have to have 75%, 0.75 rate, which is actually this one, unspecified supplier, 0.5, 0.25, becomes 0.75. That's why you have 0.75 times 5% dependency times 100%. Yeah, okay. This is how you compute the extension for suppliers, customer, or unspecified suppliers extension. Yeah, depending on how much this supplier or customer depends or impact to your turnover, scaling percentage downwards, depending on the highest dependency will be 100%, and it goes downwards. And the specified supply is the remaining of what you depend. What is the dependency on the specified? The balance is here, which is 5%. You make up 100%, then you have a rate of 75 times 100, and dependency is 5%. Yeah, okay. After you add these extensions, if there is a multiplier. Remember, earlier in the session, we talked about multiplier impact. When you're 18 months, you have 90%. When you're 6 months, you have 75%. So in this case, let's say the indemnity period is 18 months. So your premium just now we computed was 14,875. Let's say example is the premium computed 1875 because you are 18 months indemnity period. So you only charge 90% of it becomes 13,387.50 cents. Yeah, that would be your final computation. Okay, I have now completed the entire session. Before we move to case studies, which is also kind of a revision, let's just summarize what we've gone through. Number one.
Mr. Yap.
Yep.
Mr. Yap,
Yes.
the last figure, can you turn back to the last page?
Last page. Yes.
Okay.
This one.
Yeah. The figure should, I think the final premium, 14,875 should, because 18 months should times 1.5 and times 90%, what? The multiplier. No 1.5, there.
There's no 1.5. Why 1.5?
18 months.
Oh, because you're talking about intermediate period 18 months, right?
Yeah.
Okay. When you do 18 months, it's not talking about the rate, it's talking about when you determine the sum insured for gross profit, your formula that we derive, everything must be worked towards 18 months. I'm saying the formula that we use here, yeah,
Mm-hmm.
your turnover here, you have to use 18 months turnover, because here, when you do financial report, you're looking at 12 months, correct?
Yes.
Yeah. So your indemnity period is 18 months, you could then look at turnover for 18 months period, not 12 months,
Mm-hmm.
right? When you do that, your gross profit here will definitely be different, compared to your 12 months period.
Mm-hmm.
So you already adjusted this here in your gross profit sum insured using 18 months turnover. Hence, your rate, you don't have to times 1.5.
Okay.
You get what I'm saying?
Okay. Yep.
Okay.
Okay, thank you.
Okay. Any other questions? I was trying to refresh what we just studied. Any other questions? Basically, we have covered number one. We have covered this. We have looked at what is payable, what can be payable under gross profit, how to determine the gross profit. Yep. Yes. Is there a question? No? Okay, then after that, we have covered how do we pay, how do we do a claim assessment. We need to find out what's the reduction in turnover. We need to find out what additional would increase the cost of working that the insurer has to pay. We then look at what can be saved and we then check whether some insurance is adequate or not, So basically we covered that. We have looked at formula, how to derive gross profit. We are looking at what is the rate of gross profit, and then how does indemnity period, annual turnover comes into play to determine your reduction. Then we apply circumstances clause to see whether there is any trend or not, So we need to adjust the trends. Then we see what is the increase in cost of working, less sum insured, and so forth. Then we look at clauses, extensions, and rating. How will premium? Then of course, another important factor is the insurer must make projection of future profits, because we are actually covering future profits, not current, not the historical profit, future profits. There must be a projection of what the future profit should be, and extension and so forth. Okay. Then major clauses that you should include. These two should be included. One is already automatically included, which is premium adjustment. It's just that whether at the end of the policy period or at the finalizing of the financial audit, whether you will want to look at a premium adjustment here. Then the clauses, then you need to apply, then rating, and that's it. Yeah. So, no, any questions?
Yeah. Mr. Yap, hello.
Yes.
Can you get back to the slide where you mentioned that you assume that 18 months one that IP? I can't get it.
Which one is that? This one.
This one just now I mentioned that must multiply 1.5 because the IP is 18 months. But you say the previous slide already assumed that 18 months. Where the slide show 18 months? The previous one.
I didn't show any 18 months period. I'm saying if your indemnity period you use 18 months, then whatever sum insured you determine must all be based on 18 months turnover.
Oh.
The formula that we use here, this formula here,
Mm-hmm.
okay, what the example that I show you is all based on 12 months, right?
Yep.
Or 12 months. But now, because you have chosen the 18 months indemnity period, you use 12 months indemnity period, then you'll be underinsured because you are covering 18 months profit. You're covering 18 months turnover, right? But when you do a financial report, basing that financial report's numbers is a 12 months figure. So the whoever is in charge, the insured, the accountant is in charge of the particular factory or business will now have to rework his numbers to use all this has to be based on 18 months turnover. What is the closing law after 18 months? What is the work in progress after 18 months? All this will be based on 18 months period to come out with your gross profit, not 12 months. 12 months will be not correct because you are covering 18 months loss of profit. You get what I'm saying?
I'm
So in
lost.
that sense, at the initial point of the sum insured, you already covering 18 months gross profit here. Therefore, the premium the premium that you charge on the sum insured is already 18 months. Therefore, you don't need to have newly times 1.5. You get what I'm saying?
Mm-hmm.
Or are you not sure yet? Still not sure yet?
Okay, because I can't find which slide you mentioned 18 months.
Or the slide you say 18 months.
Ah.
Okay. Wait a minute. I search that for you. Okay, here. The multiplier table is here, is the formula. You cover 16 6 months period, but you still take 12 months turnover. Yeah, as explained just now. Your rate is 75% of the premium that we computed. You take 12 months, that's the same, 100%. You take 18 months, you only charge 90%.
Okay. What I learned is because you take longer from your this multiplier. Well, if the period is longer, the premium will be cheaper.
Slightly cheaper, yes.
But what I learned is I need okay, if 24 months I need to times two first. Because two years that 24 months is 2 years. Need to time 2 and then time 0.85. What I learned before.
Mm.
Because you insert longer, you'll get cheaper premium. How? The premiums, okay, let's say 24 months should be double, but due to this multiplier, you get cheaper a bit only.
Yeah, but then your sum insured should be much higher. We talk about 24 months.
Yeah.
Your rate is already times a higher sum insured.
Because your indemnity period is double one.
Not that
I confused. Okay.
not that I know of lah. To me, it would be your sum insured when you take 24 months.
Yeah.
The mid period should be much higher than you take 12 months in the mid period because you are carrying 2 years loss of profit compared to 1 year loss of profit. Your sum insured will have already catered for that, for the loss of profit. When you times the adjusted loss of profit, the gross profit sum insured, which is 2 years loss of profit, and you times another 1.5%, that means you are doubling it. You're charging double. You already double it when you times your sum insured, which is higher than 12 months. You know my explanation?
Yeah.
Then you are doing double because your sum insured should be higher.
Okay.
Right? If you're covering 2 months loss of profit, your sum insured is actually should be higher than the 12 months period, isn't it? Correct?
Mm-hmm.
Your sum insured should be higher already.
But back to your questions, the 18 months is cheaper. The premium is cheaper than the 12 months one.
Yeah.
Should be higher one.
I presume it's cheaper because although you have 24 months, you may not be using 24 months. So that's why they give you a discount. Then
Okay.
on the other hand, your 2 months indemnity period, you also have seasonal. Seasonal, you are counting twice. 1 year senior, 2 years senior. So they also give some allowance, some discounts for that kind of situation. I presume when whoever did this computation did this particular table, they were taking this into consideration. That's why there's a slight
Okay.
premium charge, premium reduction.
Okay. 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 Thank you. Thank you.
Okay. Any other questions? No. Then we just do a simple rating criteria. Sorry, case study. Just a very straightforward question. Windstorm, damaged roof, rainwater has damaged majority of the stock. The insured was unable to operate the premises for 1 month as the roof needs at least 1 month to repair. Insured has to spend additional cost to rent another location to temporarily sell excess goods that was in warehouse to ensure his sales does not drop significantly but will still suffer a loss in gross profit. Can the insured claim his lost gross profit as well as the additional cost? Quite a straightforward question. Any answers? Okay, I give you the answer. Of course, yes, there was a reduction in turnover resulting in gross profit, therefore it can be claimable. Additional cost is also payable as is a part of increase in cost of working. Case study number 2, the insured depends heavily on the supply of raw materials from a major supplier. Fire occurred in the supplier's factory and the insured is not able to obtain the raw materials. However, the insured was able to purchase 50% of what the previous suppliers can supply. The insured production has dropped since they were unable to obtain the raw materials. The insured has bought a business interruption policy but did not include any extension cover. Can the insured claim for the loss of gross profit? If yes, why? If no, can the insured ensure that it will not happen again? 1 minute. See anybody will want to try to answer this question? Any answers? No answers?
No.
No,
He need to extend specific or unspecific suppliers clause lah, in this case.
Yeah, okay, you're right. The answer is, sorry, this is the old question. Okay, answer is no, unless they extend to suppliers extension. The next question, insured gross profit, some insured are based on 2022 accounts. Insured period insurance was 1/4/23 to 31 March 24. The mid period was 12 months. Fire happens on 28 January 24. In 22, 23, 24, sales has increased. Hence, the insurer has enjoyed a higher profit in 2023 and 24. Will average apply in this claims assessment?
Yes, will apply. Average will apply.
Thank you for your answer. Yes, average will apply because they didn't do a projection of the growth in 23, 24. Therefore, it will be underinsured. Yeah. Part 4, we just want to know what is the rate of gross profit. Basically, formula is turnover divided gross profit divided by turnover. Very straightforward. That will, I think, since it's such straightforward, I think I'll just give you the answer, which is 1.3 million gross profit divided by 4 million, which is 32.5% rate is the rate of gross profit. Yeah. This is a little bit more computation. This is just what I have gone through again using the projection. What will be my gross profit? Yeah, just another example. That would be the situation. Just like what I provided just now, you need to predict 2 more years, rather 3 more years, because the fire can occur at the expiry of the policy. 10% in the year of insurance, 10% if there's an increase of 10%, projection 10%, because your policy runs into the next year, this one, and then maybe period runs into another year, hence the total is 311,690. Yeah, just to illustrate that you insurance needs to do some projection. Yeah, basically. Yeah, okay. That's all. Any other further clarification or questions that you need to ask or clarify before we end the session? No questions? I hand it back to Alex. Before doing so, I'd like to thank everyone who has participated or everyone who have attended this session. Thank you very much. Thank you for listening to me for more than about 4 hours, trying to explain to you what business interruption is it. If you are still not very sure, you can always go to your insurance company, go to whoever is servicing you, and ask for explanation. And before you want to continue selling this product, it's very important that when you want to sell this product, the understanding must be there, so that when insurer asks you anything about it, at least you're able to explain certain things. The concept has been explained to you. You don't actually need to compute the assessment, claims assessment, and so forth.